Hello everybody and welcome to this special webinar event. Why special? Well, because it's happening in the shadow of the federal election, God help us all. Now there are many events that cause property investments to stop and do nothing for a while, maybe an interest rate rise, lots of negative media, a state election. We've had a few of those recently as well, but nothing stalls a market like a federal election. People just don't like making big financial decisions when there's uncertainty out there, and federal elections tend to generate a lot of uncertainty, especially when one of the major parties has policies that will impact on real estate investment. But does any of it really matter in the overall scheme of things? And that's the question I'm going to explore over the next hour or so with the help of Kate Hill, legendary buyer's agent from Adviseable. Hello, Kate. How are you bearing up amid all the electioneering rhetoric?
Well, much better now that I've been called legendary. So yes, good. We'll obviously talk about the whole thing a little bit more later. Yeah, good. You know, a lot of clients who are, as we said, just really getting on with business. So hoping to encourage lots more people to do that.
Yeah. Okay. Well, the topic we're going to explore today is, will the election change anything? And well, I think you and I agree very much that smart investors are just getting on with business anyway, because to a large degree, what property investors do and the reasons they do it aren't necessarily going to be materially affected by anything that happens in the election and afterwards. So
yes.
I'll hand over to you to start working your way through your presentation.
Yes. Yes, so thank you, and hello everyone out there who's listening now or later. The presentation as such is actually more designed to be a discussion between myself and the equally legendary Terry Ryder. So as we start through the slides, after I'll do a little bit of an intro, then it's very much a discussion between the two of us. So I have to put the absolutely obligatory disclaimer in there. Please, everybody read this. All the information that is shared here does not constitute personal financial advice of any kind, and please do always talk to your licensed professionals before making any major investment decisions. Who are we? For those of us that don't know who we are independent property investment advisors, buyers agents, and also development consultants. In a nutshell, our mission is to buy you the best available investment property in the best available growth area to suit you. And we put a big emphasis on personal. It's very much a client-first approach. We do not sell you real estate. It's all about the actual client and the area and the property that suits them. We have been working with the property investment industry for many, many years, have facilitated the purchase of hundreds of properties. Just some stats there, over 140 properties in the past couple of years, to the total value of approximately $52 million. Our focus during that time has very much been all around the country: Victoria, Queensland, South Australia, New South Wales, and we are also members of the Property Investment Professionals of Australia, known as PIPA, the REBA, the Real Estate Buyers Agency Association, and here in New South Wales, also the Real Estate Institute. All our advisors are qualified property investment advisors. We make a very big, strong emphasis on this. We are qualified to give property investment advice. It's quite rare out there. And obviously we are all fully licensed. So before we get started talking about areas and any other sort of strategies, I would urge everyone, and I say this every time, please understand your risk. It ties in a little bit with what I just said about it being very much client-focused. It's not a cookie cutter approach. What we do, you need to understand, and me as your buyer's agent, I need to understand what your risk profile is, where you're at in your property investing journey, what it is that you need from a property in terms of cash flow, the demographic, the area, etc., etc. Understanding the importance of research, of course, is critical. And as I say, we stand for a client-first approach. Then we look at the area, and then we look at the property. They are not in order of importance there. That's just the order that we do them in. It's all equally important. Terry, you'll have a lot to say about this, and I will too as we go on. You know, you made a big point of this again in your the Ryder report, which came out, which I read yesterday. I think I got the email yesterday. It came out yesterday or the day before. that we all need to understand that Australia is not one big property market. It's not a case really of when you buy generally, but also where. Property markets are fundamentally driven by local economic conditions. This point will feature heavily as we go through our discussion about the impact of the election. So at any point in time, there will be markets rising, some rising moderately, others stagnating, some falling moderately or falling a lot. Sydney and Melbourne, as we all, I'm sure, have read in the paper, are not collapsing. They've slowed down. We've got Perth recovering. We've got Adelaide and Brisbane poised and to some extent already entering into a period of better growth. And everyone out there should understand that the majority of the media do not understand this, or they don't want to understand this, or they just don't care, because that's really just not what's important in the media anymore, it seems, which is what I was reading in your report this morning, Terry, as well. They focus only on Sydney and Melbourne. They're looking for clickbait, they're looking for dramatic headlines, and they're essentially just regurgitating press releases.
Like every day, Kate, I see headlines. We do our daily research as part of what we do here at Hotspotting. Every day we're seeing articles making sweeping statements like prices are crashing across Australia. And by journalists based in Sydney primarily, surrounded by what's happening in Sydney. But what we believe to be true from our suburb by suburb, town by town analysis that we're doing constantly is that the majority of Australians are living in areas where prices are rising, not falling. And that's the reality that's revealed by the research that we do.
Yes, yeah, absolutely. Makes you wonder how they respond to the media or the articles that the press releases that they read. So understanding the importance of research and listening to qualified independent advice is so important, such as from Terry and myself. Don't necessarily listen to information, certainly not advice that you're getting from salespeople. So there's a lot on this slide. I apologise for it in advance. It's my only rant, I think, as we go through. And it addresses our point, really, in this webinar of Labor's proposed plan to address, in inverted commas, housing affordability. I think one of the points that Terry and I both make all the time is that Sydney and Melbourne's housing property boom was not caused by overactive and overzealous investors. It really was a mixture of all those growth drivers that we look for. It was time, it's population growth, it's infrastructure spending, and it's very strong local economies that fueled those property booms. It was not investors. I'll go through this. Let me just go through these points, I think, and then Terry and I can discuss. Labor's policy was essentially announced at a time really to buy votes when those housing markets were in full swing. We all know that winning elections really is very big business for every political party, and really you seem to get the impression that Labor is really interested in nothing other than stoking envy among unsophisticated folks. Really, we're not all neurosurgeons and airline pilots, but it's really the rest of us. And they seem to be telling us that property investors are essentially stupid, will pay any price to get a property, outbidding poor old homeowners, and that we're all fiddling the government coffers out of billions in taxes, and they think that this will appeal to enough people to get them into government. That's really the, so in other words, they're trying to persuade us that the property investors caused that latest housing boom because we'll happily overpay for property. We can afford to do that because of the existing negative gearing policies, and we're all neurosurgeons and really don't know what we're doing. And we're all driving property prices up. And they're saying that abolishing negative gearing will allegedly make us all see sense. It will no longer drive up property prices. It also works on the assumption that only the wealthy buy shares and investment properties, and I just don't think that's so. Slight mini rant over, Terry.
Well, I think everything you say is true. Actually, I don't think Labor's policy on negative gearing has anything to do with housing affordability.
No.
It's a revenue measure. It's a measure to try and save them some money in the budget, primarily. But it's also a certain element of the politics of envy. What they don't understand or forget is that the average Australian with investment property is an ordinary household on an average income who owns one property.
Yeah.
That's the vast majority of people have investment property, but they try to characterise typical property investors as people who own 6 or 7 or
yes, absolutely.
Property number 8 or 9.
Yeah.
And it's just simply not true. It's dishonest. I think they know that's not the case, but they are politicians, so the truth is optional.
That's right.
In their weaker moments, when they're being a little bit more honest than usual, they do talk about their negative gearing policy as a revenue measure. And when questioned on the subject at the last election, because that was their policy at the last election as well, Bill Shorten was asked a number of times, does this policy mean our property values are going to fall? And he was at pains to say many times, no, that doesn't mean that property values won't fall, which begs the question, of course, if property values aren't going to fall, how does it improve housing affordability?
Yeah.
So it's a bit of a scam, a sham. It's about revenue, but in actual fact, it saves very little for the federal budget. That's one of the points that seems to be missed in media. They keep quoting the figure that property investors make $47 billion worth of claims on their property investments. In a typical financial year, they leave out the part which says that they also declare $45 billion worth of income. So the difference between the two is about $2 billion. At the normal tax rate that people pay, the savings of the budget is actually quite minor. And they've also got the even more important point is that the reason why we have these encouragements to property investment, we're trying to encourage people to invest to provide for their retirements, for their ageing population, and a huge pensions bill.
Absolutely.
And that's kind of been forgotten in the debate. That's the very important thing. That's why most people are out there. They think they're doing the right thing by buying an investment property to provide for their retirements. But now they're being characterised as people indulging in something that's almost akin to a criminal activity.
Yeah, no, absolutely. And I posted about this quite recently, exactly that. It's a shame that it isn't talked about more, that all, most debates seem to completely ignore the reason, as you say, why most of us actually invest in property in the first place. It's kind of right there on my slide. Not to save tax. Yes, some people do that, but most of us, it's to secure a more financially and independent retirement. That's exactly right. I sort of want to shout that from the rooftops, like you say. It also, and as you say, it comes back to the tax that's been declared on income as well. None of it they don't factor in, most of us. Actually, we do actively reduce debt over time to make the property positively geared. It makes money, and on that money we pay tax. And the governments make billions in capital gains tax. New property doesn't grow as well. I'll come back to this.
Nobody's done any modelling, Kate, on the revenue that will be lost if they discouraged investment, such as capital gains tax, duty, land tax, various other taxes that really are. In fact, there was an article out today showing that the taxes that we as a nation pay on the real estate that we own are at record levels right now. It's just a moment. I might just throw that into the conversation because I think, no, sorry, I don't have this handy as I thought I did. But it was many tens of billions of dollars Australians pay taxes on property every year, and that revenue will be less if property investment is discouraged by this policy.
Yes, that's right. So I think it's as a sort of I tried to say earlier on, I think they're trying to appeal to a certain mood, a certain sentiment from a while ago. No one's ever going to be able to afford to buy property ever again. Oh, whoa, it's all those nasty investors. So when you drill down, it's nonsense, really. So
there's a lot they could do if they really wanted to address housing affordability, but this policy isn't an answer to it.
No, I totally agree with you. There's so much that can be done to encourage certainly first homeowners rather than discouraging investors. I think there's other initiatives that they could be.
Yeah. That's another 3-hour discussion. And
that's right. Sorry, I know, right? Okay, but what they are proposing to do at this stage is as follows. It's a little bit in a nutshell here, but they're proposing to reduce the capital gains tax discount from 50% down to 25%. So if you own an investment property for more than 12 months, you've had it for a few years, you sell it, you make a capital gain. If you've owned it for more than 12 months, you're only paying capital gains tax on 50% on that gain, and they're proposing to reduce that down to 25% that you're getting a discount on. They are proposing the abolishment of the negative gearing, which essentially means that you're able to claim as tax deductions your property management fees, your insurance, your maintenance, the interest payments is obviously the big one. That will be removed. It will cost a lot of people more money to hold an established property, and that's really the difference here. So newly constructed properties will still be eligible for full negative gearing benefits, and that includes both your what they call Division 42 and Division 43, your fixtures and fittings, and your building depreciation deductions. So Labour's idea is that abolishing negative gearing on established property will drive us all into buying newly constructed property. A lot more on that later. I've got a whole slide that we can talk about in terms of new and off the plan properties. They don't grow as well. It drives people into underperforming assets, being ripped off by hundreds of thousands of dollars. More on that later. And established investment properties that were purchased pre the changes that Labour are proposing to introduce will be fully grandfathered. So anyone who owns an investment property right now will be fine. They'll still be eligible for negative gearing benefits. There was the Liberal government made some tweaks to the Division 40, the fixtures and fittings write-offs as per the 2017 budgets. So they've really just shaved off, and I kind of get why they did that. It was a bit of double dipping that was going on. I think that was quite reasonable. But that was very much a tweaking of a little bit of a loophole rather than, as everyone's saying, this sledgehammer approach that Labour are proposing. So if Labour gets elected, I think as early as a few days ago last week, these changes are expected to come into force from January the 1st, 2020, as they're attributing billions of dollars of their proposed budget to all the savings they're going to make here. However, I think most people who've been reading in social media know that Labour have actually removed a lot of the costings and the money that the costings of this policy from their website recently, because it was proven to be, the figures were rubbery, let's put it that way. So that's what they're proposing to do. Terry, go.
Yeah, the figures are very rubbery, particularly how much they'll save to the budget. The numbers don't stack up.
Yeah.
The way you look at their policy, they've actually been exposed on that in the election campaign. They had quite a large section on their Labor Party website about it, which they've removed because the media and their political opponents have exposed some of their numbers as being very, very dodgy. And so they've had to backtrack on that.
Yes. So that is what is being proposed. So as I just sort of alluded to, if their proposal is to drive everyone to buying off-the-plan investment properties, then really, Terry and I, we both want to say to you, beware the revival of the spruiker. This is not a new thing, but really it will... Oh, it's going to be a feeding frenzy, Terry. It worries me, quite frankly.
Those of us who were around in the industry in the 90s can remember the Get Rich Quick seminar, absolute avalanche of seminar, and tens of thousands of people being ripped off through that process by being tipped into buying off the plan property by people who stood to gain major commissions if they did so. I think we're going to see more of that, because one of the stated ambitions of federal Labor is that they don't want to see first-time buyers competing with investors for the same properties, but this policy is actually going to end up with quite the opposite of what they intend. They're going to put property investors on a collision course with first-time buyers. First-time buyers don't get a grant anymore unless they buy new, so there's an incentive for first-time buyers to buy new. Property investors right now don't get the full depreciation benefits unless they buy new, and this negative gearing policy will mean you don't get that benefit unless you buy new. So everyone's going to have a motivation to buy new. So they're going to be competing with one another for the same new properties. And as you've just pointed out, it's going to give rise to a major revival of the speaker industry, and consumers are going to be put hugely at risk by that, as we've seen in the past.
Yeah, absolutely. So, Terry, I've put these two charts in for you, really, because I know you've got comments on two of these suburbs on the Gold Coast, which have always been interesting to debate, that market in that area.
Yeah, it's interesting, isn't it? Probably the most popular venue for people buying off the plan apartments is Surfers Paradise, which is kind of ironic because probably it's the worst performing market of all the iconic markets of Australia. Right now, the median apartment price in Surfers Paradise is lower than it was 10 years ago. I mean, it just hasn't, it's actually in a negative growth situation, if there is such a thing as negative growth, over the last 10 years. And the median price for Surfers Paradise apartment is still sort of mid 300,000s.
Yeah, as we can see here, you can see that chart. Yeah, that's right. I should stress that this is the unit market, not the housing market. Yeah.
So I know elsewhere on the Gold Coast, like Main Beach, the median price for apartments is above 700,000, and even some of the more humble, less iconic locations on the Gold Coast have median unit prices much higher than Surfers Paradise. Why is that? Well, because Surfers Paradise continues to be oversupplied by developers. It keeps suppressing capital growth, and as I said, we have a situation where typical pricing is lower than it was 10 years ago. So that's the kind of market that we're going to see people being coerced into, as well as inner city Brisbane, which has been oversupplied for a number of years and prices going backwards, and other markets like that as a result of these policies. I think it's going to just unleash.
Absolutely, and I think that I guess if you can call it a fear factor, certainly in terms that they're often sold. They've got lovely big glossy brochures, folders. They'll fly you up there and they'll tell you that you're going to make money in terms of cash flow on holding these properties. The fact that it's going to be worth less in 15 years than what you're paying for it now, they're not going to show you that in those glossy brochures, I assure you.
And Kate, there might be time, we've got some questions that are coming in. Normally we sort of leave questions till the end, but some of them sort of relate to what we're currently talking about or have just talked about. So it might be opportune to toss them into the discussion now. One attendee, just that reference you made, you can't claim insurance, property management fees, etc. The consumer is watching, says can't investors still claim those things? It's just they can't claim the losses under the negative gearing changes.
Sure. So you can. It's just about claim. That's right. It's about claiming. And I've got coming up, like in the next slide, we're doing some cash flow modelling where you'll see how that will work. So it's just about claiming if your expenditure is bigger than exceeds your income, you at the moment can claim that loss, some of that loss back at your marginal rate of tax. So that's the key. Yeah. And
Velda makes the comment that not only do we invest in property for our retirement, she makes the point, where are the renters going to live if property investors don't buy these?
Absolutely.
That's the key point. I think particularly in Sydney and Melbourne, where rental yields are very low, and without negative gearing tax write-offs, it becomes unviable, particularly now those markets aren't showing capital growth anymore.
Absolutely.
So where are the rental properties going to come from? And as someone who's got two kids out there going to uni in major cities, I sort of wonder what's going to happen to the rents. Because last time a federal Labor government disallowed negative gearing, rents went through the roof, and that's why they brought negative gearing back in within 12 months.
Yeah, there was a reason for that. Absolutely. Who's going to supply all that housing if their intention is to take so many investors out of the market to not just provide for their own retirement? Who's going to fund all that retirement, by the way, and who's going to supply all that housing? With this 30, it's your ideal sort of ratio is 30% investors, 70% owner occupiers. So that there are enough, that there is enough supply to meet the demand for people renting. And you look at the trends at the moment as well for younger people who don't want to own their own home. They want to invest in property, provide a rental home, continue renting for a little while, and have that, you know, first home a lot later down the track than that's traditionally been the case. I just don't think they've got their finger on the pulse of what's actually going on out here in the real world. Hello, you know.
Well, they're politicians, Kate. They don't have their finger on. They're out of touch with the real world and all subjects, but particularly this one.
It boggles my mind. Anyway. Shall I continue, or is there another? Do you want to?
Well, there are, but keep going, and we'll bring in some of these questions as we move forward.
Yes. Okay. So what I've done here is, when I say randomly, you know, it's not random. I mean, I chose the property, but this is a very typical property that we bought at Adviseable for a client late last year. It is in Victoria. It is a 3-bedroom, 2-bathroom house, and I just want to take you through how this looks currently for the client and how it would look if Labour get elected, if they get their policies through the Senate, and if all this takes place January onwards. This is a very normal, ordinary, what can I say, bread and butter type property. It's a 3-bedroom, 2-bathroom house. Despite how it looks, that is a 2-car garage. Don't be fooled by the window. It was built at around 1997. It's on a 734 square metre block. We got this tenanted for $380 a week. They were queuing around the block for this property, which was very nice. It's brick veneer, colour bond roof, has ducted cooling. It's got heating in terms of gas furnaces. We purchased this property for $370,000 late last year. That's how it looks. A little bit an aerial shot, some pictures. It is, when I say it's nothing special, to me, it's beautiful. It's exactly what the local demographic wants. It's neat, it's tidy, it's low maintenance, has everything that they want. It's got a bit of a backyard. That's how we're looking. So we bought this for $370,000. I'm assuming in these figures, a 4.5% interest rate, interest-only loan, 2-week vacancy, 37% marginal rate of tax, roughly. Okay, these are not absolutely precise. It's not an exact science. It's just some modelling to show you. We are borrowing the full amount plus purchasing costs. Okay, so we've got a loan amount of about $401,000. She says it's not very precise, down to the last dollar, $695,000. We rented at $380 a week. We've got expenses there at around about $25,000. That includes the loan, includes everything. Right now, you're getting a tax credit. You're getting depreciation on that property. It was built in the mid-90s, so we're still getting an amount of the building write-off. You've got a before tax cash flow there of $108 a week. It's costing you $108 a week. You can write some of that loss off at your marginal rate of tax, so your after-tax cash flow on that property will be around $61 a week. Okay? If Labour, if their proposed policies come into being, we still have the same loan amount, the same rent coming in, the same expenses. We don't get the tax credit. We will not be able to claim depreciation. We have a before tax cash flow of $108 a week. We don't have that after tax cash flow. The difference there is around $40 a week. That's how that looks. Terry, are you writing furiously?
I just thought this information was so noteworthy. I've written it all down.
Yes.
So I can share it with the world. But I mean, you do make the point quite well that that same situation, comparing the two scenarios, the investor is significantly worse off.
Yeah, look, and again, this is where understanding somebody's risk profile comes into view, because to some, $40 a week extra is loose change. To others, it's not. It is a significant amount of money. So, and again, coming back to our slide about the spruikers, what worries me is that, you know, you're going to get shown some, you know, lovely brochure of an off-the-plan property in this same area, perhaps in, or maybe not in this area, but let's go back to the Gold Coast, that might cost you exactly the same amount of money if we're looking at Surfers Paradise in a unit. And you're going to get thousands in depreciation. You'll also pay thousands in strata fees, of course. But that cash flow is going to look quite different. It'll, you know, probably be in the, depends on the rents, of course, and the yields and the income, but it's going to be in the positive. And people say, great, it's not going to cost me anything. But what is that actually costing you? Look at, you know, the impact of that cost when, as we said earlier, it's going to be worth less in terms of capital growth in 10 and 15 years time than what you're paying for it now. Lovely, it's not cost you anything to hold, and it might have put 25 bucks in your pocket every week. But to me, that's such a wasted opportunity in terms of providing for your retirement, whereas this is in an established area, great infrastructure. You don't have that same oversupply. Yes, it's going to cost you a bit of money, but you're making, you know, on average, this area historically has grown between 6.5% and 7% year on year. So,
and that's one of the key points, I think, Kate, is that the policy, if implemented, will encourage people to buy new, but it's a question of where that new is going to be located. You certainly won't be able to buy a brand new property with all the benefits in a location like this.
No, absolutely. So we just wanted to put that into context, really, to see how that looks. Moving on, the whole everyone's in wait and see mode, waiting for that right time to invest. I think, as you said in your emails, Terry, telling everybody about this webinar, people do love that reason to procrastinate. Give anyone a reason to wait for the right time. I've got a slide that I talk to sort of our groups about every now and then. When you go back historically and look at what happened back in the 90s, we had the Asian financial crisis. In 2000, GST was introduced. 2001, we all know 9/11 happened. We also had a general election. In 2002, the dot-com bubble collapses. In 2007, interest rates climbed very sharply, and we had another general election. 2008, we were in full swing with the global financial crisis. We then had the abolishment of the first homeowners grant and another general election. China's economy slows down in 2013 and another general election. We then have Brexit. We have Trump. We've got Kim Jong-un. We've got looming recessions and. And what I want to show you on the other side is the percentage growth of, if you'd have bought a property, an average property somewhere in Melbourne, not an off-the-plan property, an established, normal, median house price property in Melbourne, back in 1997, these are the growth figures of how much it would have grown since then, throughout all these civilization ending events happening, including general elections. This is based on the average Melbourne median house price from then to now. Not to now, it's that 6% is at 2016, and we know that we've had a little bit of a correction that's happening now. This year, we're having a general election, and who knows what else is going to happen out there. God knows what's going on with Brexit. Who knows whether Trump's going to get in again. This stuff is going to keep happening. But look what is happening to the median house prices. And certainly this is, as I say, I just picked an example in Melbourne. Melbourne average median house price. Look at what's going on. And you can put this off forever, but look at what you're missing out on. There's bound to be about 1,000 questions regarding this. Obviously, as we go through that increase and that percentage increase in median house prices, they do not go up every single year. Sometimes they retract a little bit, as they are now. They don't go up every single year at a lovely average great rate, right? They go down, they stagnate, they go up. This is a cycle. So, but that is fact at the end of the day. So, will the general election change anything? It'll change some things. People will still need somewhere to live. I urge you to not really overthink this. I know when we're going through these events, it can seem like civilization will never be the same again, but property prices will still keep going up. Terry.
Yeah, well, I think you make a good point, Kate. And that's that. You know, I mean, your point is don't allow events in the background to deter you from doing something you might otherwise plan to do, because, well, the evidence is there as you have it graphically depicted on the screen. But people do like an excuse
They do.
procrastinate.
They do. And look, and let me just also say, this might all sound like vested interest. I'm a buyer's agent. I work in property. I buy property for people. I completely get how this might sound. But at the end of the day, I genuinely, I care about the reason I do what I do is because I believe passionately in us all being given this fair go, to quote Labour's tagline, to do this for ourselves later on in life, to not be reliant on the government, to secure our independent retirement, so we can have a decent life and pay for medical expenses and do the things we want to do and not be, scared to put the one bar fire on because we can't afford it. This is what I believe in. And yes, I do this for a living, but I don't want people to miss out on these kind of opportunities and be swayed by, I wouldn't even call them minor hiccups. I don't know what I would call them, but little blips when they happen in the grand scheme of things. Yeah.
And there are plenty of growth markets out there in Australia right now, Kate, and we're going to talk about some of them as we move through the presentation.
Absolutely. So we will start with Bendigo. I love this market. We talked a bit about Ballarat, Terry, the last time that we discussed areas. Rising property market still. It's just been a little bit behind Ballarat. It's a rising market. It has its very own inherent strengths. It also got strong links to Melbourne. It has 8 rising suburbs, possibly more now in terms of the number of sales. It's very popular with people who are looking for that tree change from Melbourne, but that's not the only growth driver. We're not just looking at growth because people are moving from Melbourne. We have really strong population growth, expected to reach 200,000. We've had that airport upgrade. Everyone that you talk to in Bendigo at the moment is going, oh, did you know that there are direct flights from Sydney now? They're all very excited. It's a big deal. They do that for a reason when there's the demand. It's like when flights went from Sydney to Toowoomba, there was big excitement. We've had that new $1 billion regional rail link that takes everyone into Melbourne for those that work there very quickly. A lot of them do still drive. They like that road. They like that road trip. We've got the city benefiting from a lot of major companies that are based locally but perform on a national basis. We've had that $1 billion Australian Defence Force contract awarded to one of those local businesses. You've got significant retail, industrial base, tourism is big, agriculture, forestry. You've also got a bit of mining that is still significant in that area. You've got education sector. You've got the Bendigo Regional Institute of TAFE. You've got the La Trobe University, thousands and thousands of students there. Median house price currently is at $325. That, of course, is across all property, 3 beds, 2 beds, units, 4 beds. Median rent at $310. Really nice low vacancy rates. You're never vacant for very long there if you price it right and you buy the right property. And look at that lovely steady growth chart. Do please ignore that little dip, the 2019, with like 3 or 4 months into this financial year. We have not had enough settlements to warrant really what's going on there, because I assure you that dip is not happening. It's a rising market. You can see the vacancy rates coming down, but they've been low. They're low consistently in this area. It's a very solid, stable regional market.
Yeah, and it's part of a broader picture, Kate. I believe regional Victoria is the strongest market in Australia right now. I've got no doubt about that. There's strong rising markets throughout regional Victoria, but particularly those that are within striking distance of Melbourne. Of the many things I like about Bendigo, firstly, it's a strong, growing city in its own right. Secondly, the links to Melbourne are important, but it's just, as I say, we're getting investors out of Melbourne buying there because of affordability and better rental yields. We're also getting home buyers because they can see that they can live there and perhaps commute to jobs down towards Melbourne. But there's plenty of jobs being created in Bendigo itself. So it's not necessarily a scenario of being a sort of a commuter city for Melbourne. It's a very strong place in its own right.
Yeah, that's right.
Affordability is hugely important. Most suburbs of Bendigo have median prices for houses in the low to mid 300,000s. Rental yields are somewhere between 4.5% and 5.5%. And we're starting to see some pretty good price growth in some of the suburbs there, some rising 6, 8, 10% in the last 12 months. So I think it's at the beginning of something of this cycle. So it's a good time to be considering it.
Yes, agreed. So love this market. So let's just head briefly up to Moreton Bay. I talk about this area all the time. It's a very steady, solid performer. We are around about depending on traffic, 40 minutes drive from the Brisbane CBD, the port, also that airport. You've got in that Moreton Bay Shire, you see the arrow points to the actual peninsula. The Shire goes heads west up as well to Caboolture and Murrayfield too. But we've got it's a very large council area with a population of over 350,000. The area is identified by the state government. It's a principal regional activity centre. It's poised for major growth, always key growth corridor up to the Sunshine Coast with very solid economic fundamentals. And always this council, I love this council, they are working very hard to increase local opportunities. That train line that was finished within, again, a couple of years ago now, they've put that in place because a lot of people do still work outside of that council area, but the council are very encouraging of commercial investment in the area to create local job opportunities as well, so that everyone doesn't have to keep driving into Brisbane. So, and that's ongoing. We have Costco there, we have IKEA there. It is Queensland's second IKEA is at North Lakes. So, and that's not insignificant. So,
and the new university campus is going to be very, very influential.
That's right, which is at Petrie. So the suburb that I've just picked out here is Rothwell. You've got a current median price of 451,000. That's risen quite strongly in the past couple of years. Median rents, they also sort of had their little surge a couple of years ago when we broke through the $400 a week barrier. So median rent at about 410, consistently very low vacancy rates. It's a very popular area. You're close to good schools there. And as I say, all those facilities, new developments at North Lakes, you're very close to what's going on in there, and consistent growth charts going on. So, go on, sorry.
Just pointing out to people down the bottom of the screen there, that chart with the blue bars on it, 1.3%, that's actually the vacancy rate, which is very, very low in this area. Just another of the factors that make it attractive to property investors. We've recently, we're at Hotspotting, we're always doing the suburb by suburb, town by town, right across the nation, looking at what's happening with sales activity and with prices. The Moreton Bay region has more rising suburbs in terms of sales activity than anywhere else in Brisbane, and one of the highest anywhere in Australia, but prices are reacting to that. Right now we have 20 suburbs or 20 markets within the Moreton Bay region where prices have grown by more than 5% in the last 12 months. And there's another 18 which have grown by somewhere between 1% and 5%. So when you see the figures published in media saying the median price for Brisbane has dropped 1% or it's risen up 1%, and it gives the impression there's no growth happening in Brisbane. Well, this market's very much an exception. Most of the suburbs here are not only growing in price, but they're not booming, but most of them are growing by more than 5%, somewhere between 5 and 10% in the last 12 months. So it's a pretty good, solid market, affordable, low vacancies, good rental yields, and growth is happening.
Yes, and can I just say, very little really good stock as well at the moment. So things are selling quite quickly. Anyway, that's why you need a good buyer's agent. Okay, moving just that little bit further north, the Sunshine Coast. I continue to really love this market. That council has done so much to develop the area. It is Australia's 10th largest city. You've got really rapidly growing residential and tourist region here. Twice been ranked as the second highest performing regional economy in the whole state. You've got significant investment in the region, many infrastructure projects completed and underway, Local industries broadened, which is what tweaked my interest when they started to happen. So we're not just talking about tourism like we are in the Gold Coast. You've now got all this other stuff going on. The university at Sippy Downs, UE have the insurance company have their Southeast Asian headquarters here. The hospital complex at Bertinia is immense. It's extraordinary what's happened there. You drive through there and you're like open mouth going, wow, it's like a whole separate little village. Town even, it's huge, and thousands of people are employed there right now and will continue to be as that complex expands. Vacancy rates again lovely and low at 1.6% at the moment. Very stable area, continues to have great growth potential as more and more people are moving. I personally know people who've moved up there because of the whole lifestyle change. Great weather, job opportunities, affordable real estate. When it, of course, in comparison, say, with Sydney and perhaps Melbourne. The other thing that's unusual and that I want to point out about this area at the moment, we've got a median house price of $530,000. I think you are going to need to spend that for a very decent 4-bedroom property, but you're also going to get about $520 a week rent for it, and it's unusual to get that kind of good yield in an area where the properties are perhaps more highly priced if you're looking at a regional area. So, and that's unusual. So, yeah. And you're buying newer style properties, you know, so they can be anything from maybe 12, 8, 7 years old. So.
And price growth is happening, Kate.
Yeah.
Just at the weekend, I finished doing the town by town, suburb by suburb thing for regional Queensland, and we found that there are 99 markets in regional Queensland where the median price has grown by more than 5% in the last 12 months. Now, 38 of those 99 locations, those markets, are in the Sunshine Coast region. So a very high percentage of the growth markets in regional Queensland right now are happening on the Sunshine Coast. 38 suburbs with median prices by more than 5%, and another 24 suburbs where prices have risen but by less than 5%. So plenty of growth happening there. And as you can see from the chart at the bottom of the screen, 1.6% low vacancies. It's a very strong market, and it's a very strong story. It's an economy in transition, thanks to the council and major spending on infrastructure, and it's ongoing. So it's at the beginning of something. Yes, right.
We're now going to get on a plane and fly for 5 hours to the west side of our glorious continent and look at Perth. We've been talking about Perth for quite a while. I've been looking at this area for about a year. I was over there last year, exactly this time, Terry, wasn't it, that we bumped into each other?
Yeah, we just happened to be in the city at the same time.
That's right. Yes. Look, it's still, as I said, one of the very earliest sides. We are very much in a recovery phase. I have property here. I know it's happening. I see it in other, with other data that I have. So this particular suburb, I'm going to hurry up because I know we go on forever. And I've got the next area is just slightly north of there. I'll just show you there. We're moving just slightly north of Joondalup. So this particular city of Stirling, it's one of the largest LGAs, if not the largest LGA in the state, population of 220,000. You've got the second largest employment area in WA. It's one of the steadiest precincts, has been during that downturn that Perth had. You've got great shopping and education facilities, good transport links into the Perth CBD. So you've got 3 major retail centres. There is nothing but shops here. So again, when you explore this area, every shopping centre has been expanded, is being expanded. You've got the Scarborough Beach redevelopment going on. You've got 3 different tertiary institutions, Central TAFE, ECU University Campus and Swan TAFE. You've got the major public hospital, private hospital. It's seen some growth, some of the higher price suburbs seeing a rise in the median house price. So, but it has been very stable. You're looking at a median house price in the mid 300s, which when you look at any capital city is is extraordinary, that kind of price, and a median rent of 330. So the yields aren't bad. And you can clearly see at that chart with our blue chart here, 2.3% vacancy. That was considerably higher the last time we discussed this area. Those vacancy rates are coming down. The commercial vacancy rates are all coming down. Lots of mining projects being funded, going ahead. That economy is definitely improving. And everyone that you talk to is sensing that change. So to me, this is the time, this is the opportunity. I will say it doesn't continue to be without any risk. Of course it does, because we don't know, no one has that crystal ball. We don't know how long the recovery is going to take before we get up there. But I know it's in people's nature to just wait, follow the herd. By that time, most of the upswing has happened. So again, it's consider the risk, but I think there's a real opportunity here. And before you jump in, Terry, I'm going to really quickly cover just further north, Joondalup. It's literally a few suburbs up. We're driving another 15, 20 minutes north. It's again one of Perth's very steady property markets. When you look at the growth charts, yes, been some ups and downs, but you don't see that plummeting of growth charts when you look at the more volatile markets in Perth and also around the country. You've got very strong amenities here. It's a really nice area. All the facilities are there, big shopping centre, hospitals, medical facilities, again, university campus. You've got a slightly higher median age here. It tends to less be perhaps first owners, more upgraders, but all the facilities are here. You've got a very high level of home ownership, which can sometimes lead to slightly increased vacancy rates. But you do get very stable growth, very stable capital growth here. It is still a developing area, certainly to the north of that as well. But I think that this is a better opportunity than Wanneroo, perhaps a little bit further up there. You'll see that median house price, which is slightly higher than higher, not slightly, it's considerably higher than when we looked at in sterling just now. And in the mid 400s, a median rent of around 410, 420. But again, you can see those vacancy rates coming down, and that capital growth holding from after that peak in 2009. Right, Terry.
Yeah, well, I think
Perth.
I think what you say about Perth is true. The city of opportunity, and all the hallmarks of recovery are in place. Vacancies a year ago were above 4% across the board now. On average in Perth, it's below 3%. Rents are starting to nudge upwards. We have information from a host of reputable sources confirming that rents are on the rise again. Yeah. Our research shows that sales activity has been steadily picking up, and we're starting to see a return to price growth. And again, we have that situation where media publishes one figure to describe an entire capital city, and that one figure for Perth at the moment, according to most sources, is still a negative one, like -2 or -3%. For the last 12 months, but that doesn't mean that everywhere is down in Perth.
No.
And the research we did recently, suburb by suburb, we found that 40% of the suburbs of Perth now have median prices higher than 12 months ago. And that's particularly so in Joondalup, the Joondalup local government area. There are a number of suburbs which are now up compared to last year's, somewhere between 1% and 5 or 6%, so it's not massive yet, but it's just another piece of evidence.
Absolutely,
recovery is underway, and that makes it a good time to buy. Because as you point out, most people are herd animals. They wait till they read that there's a boom happening in Perth again, and it has boomed a number of times in the past. It's quite common for Perth to be the national leader on price growth. Not recently, but it has been in the past. No doubt it will be again. Don't wait till you read there's a boom on. Now is the time to be looking in Perth, where prices are still relatively down, and the recovery momentum is just starting to build.
Yeah, that's right, exactly. Okay, back on the plane, and we're going to head about 3 hours back southeast, Adelaide. So always underrated. Look at that growth chart. Really, it's a no-brainer, isn't it? The vacancy rate, 0.5%. We are about southwest of Adelaide CBD. I absolutely see this as one of the leaders in that Adelaide market. Has very, very good long-term resilience. I'm quoting you there, Terry. The area has very much overcome adversity, reinvented itself in terms of industries. It was impacted by the demise of the car manufacturing industry, has reinvented itself in the industries of health, education, also innovative technology. You've got around $2 billion, both in private and government investment, being spent on the redevelopment of that Tonsley precinct. Phenomenal what's happening there. That's leading to new enterprises, jobs creation, and it's on the site of that former manufacturing plant. You've got the new teaching hospital, university campuses that are already in operation. Major transport projects are improving the connectivity between freight hubs, seaports, creating further opportunities for businesses. It offers, again, very affordable real estate and low vacancy rates. We've got a number of suburbs showing good growth in median price over the past year, also more expected in the future. Long-term capital growth rates, very solid. Median house price in the low 4s, median rent in the kind of the high 3s. It's going to depend on the property. Obviously, these median figures lump absolutely everything into one bucket. Very low vacancy rates, very stable growth chart. And, you know, as I think just generally a sentiment around Sydney and Melbourne is not that great. It does create a bit more of an interest into places like Adelaide, also Brisbane, and those brave enough to actually consider Perth. But yeah, I love this area just for everything. Yeah.
Yeah, I understand. I agree with you too. I think Adelaide, I keep referring to Adelaide as the most underrated city in Australia. Eventually, Australia is going to discover what Adelaide has to offer as an economy, as a city to live in. Yeah. Because I like Adelaide a lot, but also as a place to invest. I keep referring to the suburb by suburb stuff that I do. I'm just right now. I'm doing the latest stuff for Adelaide. Haven't finished it yet, but what really strikes me as I go through Adelaide suburb by suburb is how incredibly consistent it is. I mean, the demand in Adelaide suburb by suburb is just so consistently strong, has been for years, and it just keeps chugging away, producing growth, but flying under the radar screen of investors. And there's really good growth to be had there, but I think it's going to be advanced in the future once Australia wakes up to what's happening in Adelaide. It's the high-tech innovation capital of Australia. We've just had the decision to locate Australia's new space agency in Adelaide for that reason. We've just had Technicolor, which is this iconic company that's been involved in movies forever, moving their Australian headquarters to Adelaide. Elon Musk with his Tesla batteries thing, he set up his Australian headquarters in Adelaide. And there's a list as long as you are of major national and international enterprises who are setting up their Australian headquarters in Adelaide because that's the happening place for high-tech innovation, which is where the world is heading. And it's going to matter, I think, very soon. It's also the number one state for alternative energy, which is something that Australia's heading increasingly towards, wind farms, solar farms, etc. And it's all translating into a very strong property market. And I agree with you that the city of Marion is probably lots of good growth markets in Adelaide, but Marion would be my number one pick for all the reasons that you point out. Yes,
really quickly, because I know we're running out of time. Onkaparinga, again, it's like Moreton Bay, features consistently here. There is a reason for that. Very consistent growth charts, like the city of Marion. Very low vacancy rates, consistently. I don't think quite the same level of infrastructure, mega infrastructure as we're probably going to see in Marion. But your pricing is a little bit different. It depends on your budget. But it's a very attractive seaside location, very steady growth charts, above average rental yields. We keep talking about the duplication of the Southern Expressway. It's old news now, but it was a big deal. You've got that upgrade of the Darlington Expressway. Council, again, always actively courting outside investors, revitalising the Noarlunga precinct, and really an influx of population growth. I find often Adelaide is a little bit mediocre in terms of population growth, but some of these specific, as a general stat, but some of these specific suburbs are quite strong on that. And again, that's for a reason: lifestyle, jobs, affordable real estate. So that's the end of our areas. And I just want to finish off before Terry tells me questions and stuff. please do give me a call. Absolutely no obligation. Chat, portfolio review, call me, email me. That email address is right there below, or there, however you're looking at me. I always offer $500 off our full standard buyers agency service if you sign up with that code word hotspotting. Follow me on Instagram, on Facebook. I put up videos from field trips, the kind of properties that we're buying, the rents that we're getting, and that kind of thing. So just want to get that out there before we run out of time. Terry.
Okay. Well, we're just on the hour, but we're not. It's not like Big Brother's going to cut us off because an hour is up.
I was worried I was going to get this big cross in the screen going. Yeah.
No, I'll take your side and talk to you later. But we've got time to sort of deal with a few questions. Perhaps if people want to type their questions into the Q&A panel or the chat panel before we wrap it up. There was a question that came in earlier, referring to the example you gave for the Moreton Bay region. You mentioned Rothwell as a suburb, saying I have a home near Rothwell and it's flooded with investors. I thought this was not a good thing. It also mentions that crime is high in that area and wondered what your comments were.
I'm not aware of Rothwell being a particularly high crime area. I'm sorry that that person has had that experience. I have not seen any stats that indicate Rothwell particularly being very high on the investor front. My research shows a completely normal ratio, that normal ratio of investors to owner occupiers, which is one of the reasons that I buy there. You are going to get occasionally, I would say, a heightened interest from a particular buyer group, be that investors, be that homeowners. I was finding about a year and a half ago, when I was buying for a couple of clients in that area, that I was almost the only buyer's agent buying up there, and consistently I was missing out to owner occupiers offering 30 and 40 grand more than me. It was first and second homeowners that I was up against. It was not
kind of a contradiction of the general theme that politicians put out there of investors will always trump home buyers, and I don't think it's true. I never thought it was true, but that's an example.
Yeah. But I do hear that point, that I think occasionally there's going to be there might have been a magazine article, something in the paper that spooks, the Redcliffe Peninsula. You're going to get that in Deception Bay, in Rothwell, in Kalanga, in Kippa-Ring. You're going to get that sort of but that tends not to be consistent, if I can say that. It'll change.
I mean, Rothwell's right next door to Deception Bay. I know a lot of investor interest over recent years has been focused there. You can buy property there very affordably, and quite often with the ability to perhaps do a development there, depending if you get the right property.
Yeah, look, I'll be honest, I always am. the figures are going to be quite hard to make work in terms of your buying price and making that development feasible. So I think there would need to be either a really good, to state the obvious, a really good buy-in price of the land that you're buying, or the end product needs to be worth a lot more than what you're paying. At the moment, you're kind of spending a little bit more on the whole development project than what it's actually going to be worth at the end in that area. At the moment. But that will change over time. If you've got time to sit on it and hold and cope with the negative cash flow and sit on it for a while, then that's generally how these kind of areas can work, just in terms of development feasibility.
I think a final point about Rothwell, from memory, it does have a train station on the new train line, doesn't it?
Yes, it's just this that sort of southeast side of the Anzac Road, where the big roundabout is, that's normally gridlock. Before the Deception Bay Road and Anzac Avenue is just to the southeast of there. There's a little sort of new housing development there as well. Yeah.
There's a question from someone who's been tuning in, Kate. I think maybe misheard something you said, but I was saying, are you saying that new property never grows in value?
No.
I don't think you were saying that.
No.
But you were urging caution for various reasons.
Yes, it's all going to come down to the area. I am not saying that off the plan doesn't work. If you'd have bought but it very often doesn't work. So if you'd have bought in Sydney an off the plan property in 2011, you're going to be rubbing your hands together with glee, right? But if you'd have done that in other areas, many other areas, you won't be. I can't tell you the amount of times I am buying a property from someone who bought off the plan 10, 12 years ago, and I am paying often $50,000 or $60,000 less now than what they paid for it back then. It happens all the time. But if you're buying something that is not part of a major development, and it's in perhaps a more established area that has all these growth drivers, it can work, but you're just naturally you're going to pay a premium for brand new. Everyone needs to make money when they do this. The developer, the builder, the marketer, the people selling you the thing, they all need to make money on this, and you pay for that in your purchase price.
I was talking to a very well-credentialed property professional about these issues just last week, and he made the point, the way he put it was that it's very easy to hide a $20,000 or $30,000 spruiker commission in the price of a new off-the-plan property, and that's one of the issues.
Yeah. And, I mean, I was hearing stories, a few months ago of the spruikers, certainly for Melbourne units, offering $60,000 and $80,000 commissions to anyone who would take it, accountants, financial planners, to offload them to their clients. $80,000. And then they wonder why the valuation doesn't come in. Anyway, sorry, don't get me started. Yeah.
Because those fees get reflected in the price.
Yeah. Not saying it doesn't ever work. It can work. You just need to do the numbers, and you need to not overpay. Sorry, the end of rant.
Yep. Okay, look, there are still some questions coming in, but I think it's probably we're now at 10 minutes. We should probably wrap it up.
Yeah.
Otherwise, we could be here all afternoon talking about real estate, which I love to do.
I love it.
Look, just in wrapping up, if anybody wants to follow up on anything we've talked about today, or feels they have a need for a really good buyer's agent, Kate's contact details are on the screen right now. I think, from my own personal experience, that having a good buyer's agent on your team is such a benefit. You do pay a fee for it, but I think the benefits you get far outweigh the costs in all sorts of ways. So I do urge people to consider that as an option. Certainly a great time saver. For me personally, got a very busy life, don't necessarily have the time to do it all myself. But thank you, Kate, for yet another great presentation. I always like doing these webinars with you because the information you impart is always so good and based not only on good research, but also your experience at the coalface of the industry right around Australia. And I think the points have been well made today that a smart investor would not be sitting around waiting for the result and outcome of the federal election. They'll be getting on with business right now, because regardless of what happens with the election, there are opportunities out there, growth markets, and what you buy today or next week isn't going to be affected by anything that comes out of the federal election. So don't sit down on your hands, get out and get active and take advantage of the opportunities that exist right now in various parts of Australia.
Yeah. Well, thank you for the opportunity, Terry, always.
You're welcome. And just finally, again, contact Kate with the details on the screen if you'd like to follow up in any way. Thanks everyone for participating. It's been my pleasure to be part of it. Enjoyed the discussion. Thanks again, Kate. This is Terry Wyatt from Hotspotting signing off. Let's do it again soon.
Let's look forward to it.